Welcome from me, Guy Munson, to our regular 6-minute strategy. Looking at markets this month, you might be forgiven for feeling the summer blues have come early. First, a near 7% fall in global equities over the month was material, but it still leaves the world index up about 6% for the year to date. The losers unexpectedly were the giant AI technology names that have led markets to date. Nvidia, for example, is down 23% on the month, but still up 100% for the year to date. As you'd expect, momentum styles buying what has just gone up saw a big correction, while growth stocks gave ground to more value names and defensive dividend payers. This widening of equity leadership is desirable, but it still shows the need for careful risk control on these AI tech supertankers. Second, the return of other assets, by contrast, has been reassuringly dull. The dollar has been pretty well flat for the year. That's a good sign, signalling there is no fear-driven flight to the US currency. Oil prices are also little changed, as the conflict in the Middle East has not yet mercifully escalated across the region. Gold, by contrast, remains the star, climbing 15%, and is a key holding for us. Third, the carry trade, borrowing low-yielding currencies and buying higher-yielding, has moved dramatically into reverse as the yen has soared. Again, this de-risking is to be welcomed, but an unwind on this scale can create backwash for other assets. So let's look at this string of events in the slides ahead and see if there are any unifying themes for your portfolios. So let's look at the performance of global equities for the year to date in the left-hand panel, that blue line rising sharply up till last month, then coming off quite rapidly with a decline of around 7%, leading the overall world equity index up by about 6% for the year to date. Let's break that down by factor contribution. Momentum, that's stocks that rise day after day after day, the dominant factor, and then led the reversal. That was, of course, those AI tech stocks which just kept rising until the market cracked a few weeks ago. Also, growth behind those technology names starting to underperform, value and dividend yield coming to the fore. Now, this broader leadership of equity markets is undoubtedly what we wanted to see, but that handover can often be tumultuous, as it was over the last few weeks. Why am I not worried about those technology stocks longer term? Well, the position is very different from what we saw 25 years ago, back in 98-2000, when the internet stocks led the market up to what turned out to be a bubble. Why was it different? Well, the contribution of profits was much smaller. In the left-hand panel today, that blue bar, that's profits, earnings, cash flow, whatever you like to call it, has been a real part of these returns. These companies have been super profitable. And the yellow bar, which is the expansion of PE multiple, the bubble if you like, has been relatively small. Compare that to the right-hand panel and you can see that yellow bar, those PE multiple expansions dominated returns. And of course, when the crash came, there wasn't much earnings potential underlying profits behind many of the internet names. It couldn't be more different today. What else has been happening over the month? Well, of course, we've had the unwind of the great carry trade. What's a carry trade? Well, it's when you borrow in a low-yielding currency like Japanese yen, that light blue line, and reinvest in a high-yielding currency like the Mexican peso. Back a few months ago, the yield on the Japanese currency was actually negative, compared to an 11% or even higher than 11% yield on the Mexican peso. A huge difference you could pocket, in addition to which the Japanese yen kept falling, so you had a wonderful FX benefit as well. Well, as inflation in Japan has started to normalise and the Bank of Japan has felt more confident about pushing rate rises through, that of course has gone into reverse. And you can see on the right that dark blue line, the yen peso rate rising sharply as the yen begins to accelerate, and that unwinds the carry trade. And often that causes a lot of backwash in other markets. We haven't so much seen it this time. What it does mean is that as the Japanese economy normalises and the currency normalises, there'll be some very interesting investment opportunities. Thirdly, in other assets, the year-to-date has been actually reassuringly dull, and we didn't see that surge in volatility we saw in equities in July. If we look at the dollar, broadly flat for the year, extraordinary when you think of the geopolitical challenges around the world. Oil up very modestly for the year to date. Again, extraordinary when you consider the tension and the military conflict in Ukraine, Russia, and of course the challenges in the Middle East. On the right-hand panel, you can see bond yields, which rose quite sharply as worries inflation dominated the early part of the year. But now we're worrying, if anything, more about a slowdown in the US economy as the labour data has got worse. And that's allowed yields to fall again. So actually no move in bond yields of any significance for the year to date. The star in the bottom left-hand panel has been gold up 15%, a key part of our underlying investment allocation. So let's try and wrap this up. Well, certainly this wider market leadership is good, and yes, we may need to manage position size and put risk controls around these big AI tech names. Yes, in the short term we may overestimate the new technology of AI. In the longer term though, we normally underestimate the impact, and that's certainly our thinking here at Saracen. Secondly, a wider market leadership will give us great opportunities in value and dividend yield, and in some of the less loved of our themes. Thirdly, it's encouraging that other markets, the dollar, bond yields and energy, are reassuringly dull. This shows that the geopolitical stress isn't yet cascading into world markets too intensively. Fourthly and finally, of course, we have the miracle of Vice President Harris, as her numbers just keep rising. On the predict betting site, she's now ahead of Trump as a potential US presidential election on November 5th. What it also suggests is even these numbers are not valid yet. It suggests that the possibility of Trump having a red wave where he takes the White House and both houses of Congress is much reduced. That means the possibility of getting his income tax cuts reinstated out into the future, or indeed his tariff plans, is much lower, and that puts much less financial and economic risk over the US economy in the years ahead. So that's broadly encouraging. So I hope that gives you an idea of the factors swirling around the world, how we manage them, and in the meanwhile, get on and have a great holiday. Thank you.